Hello and welcome to Fireside with VC. My name is Andrew Romans and I'm super happy to have my very good friend, Brian Cohen, on the podcast. Brian is a very interesting person you could spend a lot of time with and never talk about business, but he also happens to be a legendary angel investor, now becoming a legend in the venture capital business, invested in some small companies very early that we've all heard of, like Pinterest and Comixology. I think Brian was also, I know for sure, is the chairman emeritus of New York Angels, who I'm proud to say some of those guys are LPs of ours. Thanks to Brian inviting me to be a speaker from time to time there. And right now is co-founder of New York Venture Partners, which has made over 100 investments, I believe, and has a cadence of about 3 new investments per week. And he fits all this into his lovely life, which can't be too easy. Well, Brian, thank you so much for coming on the podcast today.
I'm excited to talk to you, my dear friend.
So let me start with one question, and we'll get into everything else. What is the one word of advice, or knowing you can break it into maybe 2 or 3, and then we'll go into deeper on this, on raising funding from angel investors and VCs. So if our listeners want to get your advice on that, what's 1 or 2 things you'd say there?
So, I mean, you know me well. I'm emotional, right? And I think we don't really recognize how emotional angels are, or VCs can be. They want to make a connection. They certainly don't have a lot to look at. They talk about all their due diligence, which they don't do very much of anymore. So their real interest is to make a personal connection. It's personal. So when you begin the conversation with whoever it maybe you're raising money from, find some personal connection, a high school, another friend, some relationship which brings you just a little bit closer to them. And then talk from the heart, not from the brain. I've discussed this with many people. I think I noted it to you once. Everybody starts with the normal, let me tell you what I'm doing, right? But no one really starts with, let me tell you what I believe. Did you feel it when I said, the minute you want to tell somebody and share with them something you believe, they go, whoa, wait a minute. That's unusual. What do you mean what you believe? And then you go into pretty much the nature of your business, but from the vision and product standpoint, not from necessarily the mission, which is transactional. So that's the number one thing I've learned. Now, I've studied this for 30 years. I've asked angels and VCs in questionnaire after questionnaire, why do you invest in these companies? And a lot of it comes down to the same reason why people do business with people, because they want to. People do business with people they want to do business with. And the same thing applies to venture. Now, there are obviously, issues that interact with that and change that slightly, but that's the core. That's number one.
Okay. Well, no, that's good. And, I do know you well. So that was the answer I was expecting to hear. And Brian's an author of a book, What Every Angel Investor Wants to Know. Did I get the title right?
Yeah, wants you to know. That's right. Yeah.
And Brian got published 3 months, I think, or 3 weeks before I did, by the same publisher, the same everything.
That was amazing.
At McGraw-Hill. So we were both like holding our breath of how much our inboxes were going to get overtaken when we were selling so many books. But I'm actually, Brian is helping me with a section in my new book, my 4th book, which is about fundraising. And you're talking about inside baseball, kind of like the inside secrets of what's going on. And you're talking about heart. Now, I asked you to kind of give it to me really fast with one thing, but why don't you elaborate a little bit on what those core pillars are?
So, okay, so the first one is get personal as quickly as you can. That's number one. Number 2, we're all looking to make sure that the person we're investing in is in control of what they're doing. We want to watch them run a business, but we can't. We're not sitting there while they're making their phone calls or going out on sales opportunities or developing their code. We're not there. But raising money is a clear indicator. It's a little micro indicator as to their business prowess. Are they asking good questions? Do they think about how they're raising money? Are they taking even an interest in it properly? Do they know what's in a term sheet? Have they thought about it? That to me is the hugest red flag of all. If the most important thing they're doing is raising money and they don't know what QSBS is, or very important issues that relate to them personally, though it's a business, that's huge to me as a problem. Other issues are they funny? I know that sounds a little out of the ordinary, but I find also I'm very much, as much as I've built some very interesting large companies, I've always found people who are happy, interesting, and smile a lot to be the people that are good leaders. So smile a lot. Let them know that you're a happy guy. I know I'm married 38 years to my best babe in the world. Are they married? Are they happily married? Can they be a good husband or a good father? These are not normal things you read in a book.
Yeah.
Right. These are just not in there. Chapter 3, how to be a good father while you're raising, funds. Those are indicators to me about the nature of the person. Then I could talk about the nature of the inside baseball of their business. I like to know that they're thinking about the exit before I invest in them, that they're actually calculating it out, that they have a plan in mind. It isn't just this arbitrary, gee, I'm on a journey, we'll see where it goes. I like them to be in control also in mapping out that direction. Where are you going with this? What kind of time frame do you have? And if they don't have that clarity, I'm certainly not interested, but I'm much more interested if to them it's an investment. Now, if it's social, that's different, right? They're going to try and give everything they've got, and it's very personal. But if it's an investment, it's an investment of their time, it's an investment of other people's time, other people's money. How in control are they of their journey and where they're going?
And you're investing early, so the potential for a pivot is even higher, and the potential for the business to evolve heavily is even higher. So,
yes,
in a world of pivots, you're left with the person, the team, the market, and the core technology.
Right. Well, I like to have breakfast, lunch, and dinner with the company I invest in with the founders. The breakfast is to talk about the sun coming up, what's your big bark thinking, what's your large thinking. Then the lunch is talking more about the organization, et cetera. And then dinner is, more brass tacks. What do your financials look like? How do you make money? Right. So I like to do those things. Not easy anymore, obviously. Much more difficult to do that. Right.
Yeah.
But if I can, I really want to spend a lot of quality time. And that's because my background is marketing, having built a very large company and sold it early to McCann Erickson. I like to know that they understand the customer before the customer understands themselves, right? I want to know that they have spent time with customers, that they have some curiosity about what they're thinking, not what they're saying, and some way to deliver on that knowing and their understanding of what the customer's true needs are, not what they tell you they are. And you talk about pivots, Andrew, they all pivot. Iteration is the new innovation. Can they make it? The big, line that my friends always use is, will they figure it out? Right? In the end, will they figure it out? And are they not myopic so much that they're not going to sort of take into a large account other issues that'll change their directions? So, and the only way you could do that is getting personal with these founders and hanging with them. And you can't do that unless you're the first investor, really. Once too many other people get involved, they don't know who to listen to. So, as you know, my interest is to try and be the first check.
So talk about stage there. What stage arc? If you're the first check in, then these companies are probably largely pre-revenue.
Oh,
is
yeah.
that right?
Yeah.
So you're doing 3 investments a week with Trace, your partner and your son. How many of these companies have revenue at the time that you're investing?
Maybe 25%.
25%?
Right.
Okay.
I don't want to move away from that. That's what true angel investing is all about.
Sure.
That's where you get the chill up your spine. That's where the meaning of your value to these younger founders is found. I could show you countless emails saying, thanks for believing in me. it's easier to believe in somebody when they've got a couple $1 million in, revenue.
Sure.
But it's
And
harder
they're backed by
to.
first round capital already. And,
That's
sure.
right. That's right. So that to me, this is an emotional thing to me. We just had, an exit with Tommy John. And I could show you I'm sorry, but they make me cry.
Yeah.
It's got to be more than money. There's got to be
Right.
some value add here. And
Well, on the topic of money, and 2021 has been a crazy year where I think you typically saw companies raise for 18-month runways. And maybe when you're earlier, it's different. But if you only have two people, maybe you can make it last for 18 months in your mind. Now we're seeing companies go back for funding much faster. You have an announcement that the company's raised money with so-and-so, your name, my name involved, and all of a sudden they're getting a lot of inbound. And you see companies, moving quicker, faster, and valuations are going up. The size of the round can start going up. What are you seeing on how much funding do these companies raise when you're investing? Like, so what is the average check for you guys, if you can disclose that? And what's the average size of the financing round? What do these financings look like?
Well, there's no more models anymore. Things used to be, quote, traditional. There isn't that much from what it used to be, where it was pre-$5 million valuations. Oh my God, really?
Yeah, it used to be 1 million. It used to be 1 million. I remember.
I said pre-5, under 5, right? But
yeah.
yes,
In the ancient
right.
times, in the mid 1990s, when I was a founder, people kind of said, "Oh, I would never invest in a startup with a valuation over $1 million."
Right.
In the
so
old
that's
days,
gone.
You didn't raise a lot.
That's gone.
Right.
That's gone. And I would only do preferred equity. I wouldn't.
Okay. This is.
I would not go anywhere near safes. I wouldn't go anywhere near anything other than I knew what I was investing in. And I would spend a lot of time with founders teaching them why a preferred equity was a lot better for them than a safe note. But so it used to be under 5 million. Yes. 100 years ago, it was much less than that.
Yeah.
The average dollars they're raising is much more. And it used to be, I don't know, $1 million. That was a nice little number. They crept up to 1.5, but now there's just so much money. They'll take as much as they can get at the beginning and hurt themselves. So I have them take a white sheet of paper and I say, here you are. If you take that amount, what's your milestone that you have to reach? Then what do you raise at the next level and what's the valuation? And I teach them that taking too much money in the early days is a problem. Do they listen? No, they don't listen because they see all this money being thrown at them. And you said before they go after a new raise. They don't have to go after new raises anymore.
Sure. Yeah.
The money's pouring into them. Right? There's so many people calling. Will you take my money, please? So it's a lot crazy out there. There's no due diligence. Nothing. It's can I get in?
Like Dave McClure once said, and I love his words for saying it this way. He's like, look, if the company's only been around for a couple of months, how much DD are you doing? But on the other hand, some companies have been around for a while, and it really only hit you, me at this point, But so financing rounds for pre-revenue companies you're seeing, and then what would you say? I mean, I see a lot of what I see. I mean, we see companies raising $750K, or they maybe think they're going to raise 1.5. They get to $750K. They come up with a plan and say, let's just make that work and get some, build some stuff.
Because they're getting higher valuations, they can raise more money. That the dilution doesn't affect them that much. So, when they know they can get a valuation of at least 10, maybe 20 million in some cases, as a pre-revenue company, you raise 2 million.
Yeah.
You raise more.
And so how do you feel about that? So if you invest in a company at a 20 million when it's pre-revenue, and you need to sell it for 200 million with no financing between now and that exit to make a 10x return, which is not going to pay for the next Bridgehampton house. What are your thoughts on backing your way from a plausible exit into that valuation right now?
I don't do it. I work backwards. Somebody once asked me what business I'm in. I said, I'm not in the investment business. I'm in the exit business.
Right.
So I have to work backwards. I want 20x. That's my goal.
20. Okay. Yeah. I was going to say, the industry standard is if I lose a third and I'm flat on a third, the other ones have to be a 10x to get me to a 3x fund performance so I can continue to exist.
And that's for a fund.
Yeah,
right.
that's for a fund. But if that's only really interesting if it's a big fund,
Right.
So you and me splitting 20% carry on $1 billion, doing a 3x every 3 years, we can do that. Wouldn't have your passion or my passion in it really, but for you, you're saying the 10x has got to be a 20x to begin to
Yes, it
deal
has to
with.
be a 20x. I have to imagine a 20x. That's right.
Yeah. And you're neutralizing risk by the level of diversification you're building into a fund. Now, right now with New York Venture Partners, do you guys have outside LPs or is it just all your money?
All mine.
Okay. Okay. So you're free of some of these constraints or concerns, but you're still saying for this to work. And so it's hard to really say what is the level of diversification within a fund. You could maybe consider it to be what's the level of diversification within a vintage year. And that's almost healthy. So you're in a good vintage, you're in a bad vintage, and net over time, you guys are still growing your evergreen capital base.
So you know the stats, but nobody cares. It's a lottery ticket. It's gotten more lottery-like by the day. Constant amounts of money. Now the PE firms are pouring all this money in. Everything is changing. It's hard to grab onto anything, to really understand. I mean, you do this podcast with the interest of sharing knowledge, insight, and wisdom with people, right? But it's changing constantly, and I don't know who has the insight wisdom anymore.
Yeah.
Everybody's just rushing to get into all of these investment opportunities. They refer to them as deals. I don't. I refer to them investment opportunities. When you refer to things as deals, they're quick and easy, and they're slipshod. And the lawyers aren't providing the best advice either. I brought up don't do safes and so on. I fought against that forever because of so many reasons. But, the waves kept coming in, and, people want anything legal that's fast and cheap is generally a bad idea. But it was hard to get the kids and these founders to listen. So I've had to actually bend a bit. But many of the safes, thankfully, are being augmented so much. They're beginning to look like, equity deals. Yeah. Unfortunately, you don't get the QSBS. All of my exits have been QSBS.
There's some legal debate on QSBS, and QSBS is qualified small business stock. So if you invest in a company for under 50 million of assets, including your round, and hold it for 5 years and a day, there's actually no tax unless you live in New Jersey and potentially California.
Up to $10 million.
Up to $10 million. Yeah.
And then you could do stacking and give anybody you want $10 million tax-free. Yeah. So there are so many reasons to do it. And when you talk about the legal discussion that may be sort of a debate, it's not. I've heard everybody say it's debatable. I've heard that for years. It's debatable.
Right. You don't want to debate with the IRS. You don't want to debate
with
the IRS.
No one's done it. Yeah. No one's done it. I haven't seen one court case that says it's okay.
Yeah. So listen, let's talk about this because I was going to ask you what is included in your side letter agreement when you are investing in a safe or a convertible note that grant you preferred rights and privileges like information rights or pro rata equity rights. But you're saying that because you're investing as early as you do and you're making this emotional connection, you're able to say, look, if you want me in this deal, if you want us in this deal, it's got to be a price round. And well, you're pulling that because I've made strong arguments of how the safe is hurting everybody, and how convertible notes made sense when it was a bridge, like a bridge to something else happening. But that what the hell is a 15 million round, $15 million going in on a convertible note makes no sense at all. If nothing, I've been screwed by them. We've been around long enough to see some lawyers saying, you're put in this much money, that's the numerator. The denominator went like this. And this next round happens, and we want to double down on our information rights, legal insider information on it, and our relationship with the CEO, that's our earned pro rata. And then some real roughneck Sequoia type comes along and says, I've got an ownership target percentage. Even though you brought me the deal, Andrew, we're throwing you under the bus. And if this is the last deal you bring us, we could care less. And the safe allows you to pro rata into the round after that, which in today's market will be so bubbly good luck getting a 50x on anything.
That's
ever,
right.
Ever.
That's right.
The
That's
best
right.
you can get is a 6x, and it's still risky.
That's right. So I wish none of this was happening. So the only way is I could find companies that no one else finds, no one else sees. I go everywhere, talk to everyone. I have to get pro rata rights. That's like blackjack, right? You don't make money in blackjack unless you can
pro
double
rata,
down.
if there's one person listening who doesn't know what that is, it's the right to invest in the future financing round of the company to maintain your ownership percentage.
That's right. And I tell the founders, love the ones who loved you first.
Yeah. Who thinks that the first investor should be thrown under the bus, and these really nice guys from Benchmark Capital
That's right.
to be better treated than your literal, you wouldn't be here without them.
That's right. That's right. And when I don't get, and I generally get it as a side letter, but when I don't get it, I know I'm going to double down on helping them. And I'm going to earn it. Yeah. I'm going to make their lives so connected to mine and giving them advice, good quality, not annoying advice, but really insightful advice that they go, Brian, I have to have you in. I am not going to throw you under the bus. But there are those times that, the VCs will say, I want that percentage, and I'm sorry, but Brian can't get in. And I'll stamp my feet and, but I got to try, right? Got to try. So it's not a perfect world, but I try and get it to back. I get it to be something I can actually believe in.
Yep. And one part of a term sheet for a priced round that is very important that new founders don't pay as much attention to as they should is governance. And
yes,
in this evolution of the world of the convertible note, which really became a de facto standard for not doing price rounds and just doing this, the money comes in as debt and converts later, people kind of conveniently said, we're not going to deal with the expensive legal back and forth of governance, like a board of directors and board seats and a whole bunch of things that require board approval or don't. How do you, what have you witnessed and experienced with there being a board of directors where it's not just the founders, or should you have that? What are your opinions and feelings on this topic?
Yeah, so, having governance is critical. I was going to start a company years ago with Esther Dyson, called the Devil's Advocate Club. And, every one of these founders needs someone to question, what are you doing? Why did you do that? Is that the right thing to do? Does that make sense? And there's not enough of that. And that's kind of devil's advocate thing that needs to happen as an interchange with people inside and outside the company. And so governance to me is sort of like training wheels, right? It keeps you going as straight as you need to go where you need to go and where your determination is that you have to go. So without governance, I think a lot of things can happen. Certainly there could be arguments with founders about yeses and nos and what they approve and what they don't approve. There could be issues not thinking too much about exits early on, how much money to take. It is a classroom, and governance allows it to be more professorial, more conversational, rather than just running with the ball and not being absolutely sure that you know where the goal is and how far you need to go. So I really believe big time in governance. Does it have to be official board of directors? They always get scared about that because they're going to lose control. I said, no, you're not going to lose control. It'll be a 3-member board. You got 2 people, you and you're the founder or somebody you want, and the money people who also have a responsibility of watching over their investment, who hopefully are intelligent enough to provide you value, right? And it's going away. No one wants it. And even the VCs don't have time for it. They're making so many investments. They're saying, I don't have time for governance. What? You have no time for governance? That's crazy.
Yeah.
So even that is being whittled and chipped away.
Yeah. Well, I think it's important to have a board of directors that includes a non-executive director. There's D&O insurance as an expense that a really early stage company doesn't want to, shell out cash for. They want to be making product, talking to customers, really early stage stuff. But I think that one of the things that can go missing in a world of replacing the price round with all these notes is this important element. And if you're investing in 3 companies a week, you're looking at 100, 150 plus a year. You can't be on the board of directors of all those, but it's good to have a mechanism of overseeing the appointment of somebody.
Yeah, I feel as though I don't need to be on governance because I have the ear of the CEO founder anyway.
Yeah. Yeah.
And if they want me to come on as an observer, my pleasure.
Right. I mean, I had an experience once where we invested alongside some very big VCs, convertible note. There was a change of CEO, which none of us were able to, vote on. And the new CEO raised a lot of money from one investor and paid off the notes, which so basically did an MBO. And then we got a 50% premium plus the 6% interest rate, which was, paying a return, but not the kind of return commensurate with like the 10x revenue. And so we got shafted. It's an example of no board convertible note, not what we would have liked, to have seen. On the other hand, if they really want to do it as an investor, I'm not a PE guy.
Right.
And when you were saying, I like to say opportunity instead of deals, and you've said that for the 20 years I've known you, that's nothing new coming from you. There's also a bit of, I'm investing in the founder and the co-founder, and I may turn out to love the junior co-founder and fall out of love with the founder, and I'll be the first one to back their next company. So when you're funding somebody, you might fund some Bunsen burner experiment that fails.
All right.
And then you stay with that person for the next one,
Absolutely.
You choose each other.
That's right. The founder's the winner. The horse obviously may not be. I used to do that in one of my previous businesses where I knew the company was bad and I'd work for them anyway. And I knew that they would sporulate, all the executives in the company would sporulate and they'd all hire me. It was a fabulous Trojan horse approach, to getting new business. So on that note, I do have to run. Let me go.
Okay, go get your wife. And I don't know, you got my cell phone. Just tell me when you're free and we'll pick it up.
Okay, I'll get you.
Okay,
Thank you.